Bloomberg Audio Studios. Podcasts, radio, news.
Hello, and welcome to the Money Stuff Podcast, your weekly podcast where we talk about stuff related to money. I'm Matt Levine, and I write the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
Doing this off script. Who am I?
I forgot for a moment. What do I do? Matt, it was funny. Last week we joked about
the all tariffs episode.
Yeah.
The monkey hand curled or whatever.
Here we are.
Here we are. It's an all tariff episode. Katie, I'm going on vacation next week.
Yes, you are.
Service for the Money Stuff podcast may or may not continue uninterrupted, but I'm going on vacation. I mentioned that because things have been a little crazy in the financial markets, and I do have some history of things being crazier when I'm on vacation. Mm-hmm. Someone did a Substack report about whether financial markets are more volatile when I'm on vacation. Certainly Elon Musk seems to be a little bit more volatile when I'm on vacation. And one time when I was an investment banker, I went on vacation, and it was September of 2008, and the Lehman Brothers filed for bankruptcy first day of my vacation.
God.
Yeah. So we're recording this on Wednesday.
We are.
20 minutes before we started recording, it turned out that the tariffs were a joke.
I shudder to think what fresh hell awaits us next week when you are on vacation.
I know, but I think that what I'm saying is there's some chance that it's no fresh hell. It's some chance that all of the tariff excitement was this week. Donald Trump announced there's a 90-day pause on the tariffs. And
that's so naive.
Who's going to remember any of this in 90 days? Yeah. I know, it's pretty naive. But still, there's some chance that next week will be less crazy than this week. And some chance it'll be much crazier.
We can only hope and pray. But I'm glad you signposted that this is happening on Wednesday because, this podcast could be irrelevant by Friday. At least what we know right now is that Trump said that he is pausing tariffs for 90 days on countries that didn't retaliate. That means China.
Who knows, right? But it seems to me the tariffs are paused except on China.
Yes. In fact, he raised tariffs to 125%.
And by the way, the tariffs are not paused on other countries, right? They're 10%. I don't understand it.
Yeah, well,
the reciprocal tariffs, who cares?
Let's not get too deep into the details here. But this is interesting. We were going to talk about Walter Bloomberg, who sort of actually gave us
no relation.
No relation to Bloomberg News, but kind of gave us a dry run of what we saw unfold in the markets because he sent that tweet, that headline, which turned out to be fake, but it was written in Bloomberg News style about a 90-day pause. I believe it was on Monday. I was, of course, on live television, as I often am during these events. That ended up being fake, but CNBC and Reuters ran with it and then had to issue corrections. But stocks surged after that. They then came back after it was revealed that that was not based in reality. And again, it was a nice dry run. It was a teachable moment that when there is any good news that you're going to see markets absolutely explode. And that's what's happening, at least for right now.
It's so weird that it was accurate 2 days in advance, right?
Yeah.
It'd be one thing if it was tariffs are off, but it's the same, it's the real thing, sort of.
Do we want to talk about where the 90-day idea came from?
Are you going to tell me where it came from?
Friend of the show, Bill Ackman. At least he was one of I think he's the first person I saw who floated that idea, tweeting over the weekend that Trump should do a 90-day pause because it takes a long time to negotiate deals and move manufacturing, et cetera.
Move manufacturing. Yeah, look, sure. To the extent anything makes sense, it makes sense. But I do love that it's not quite that Walter Bloomberg, pseudonymous Twitter account who tweets
I want to know him
headlines.
So bad.
Okay. It's not quite that he made this up. It's someone asked Trump advisor
Kevin Hassett.
This is the thing, with the Trump administration, you can ask anything and they'd be yeah, maybe. So they asked Haslett, what about a 90-day pause? And he said something no, but you could sort of read it to mean maybe.
He made a noise and then he said,
or Bill, I think that the president is going to decide what the president's going to decide.
Which is not exactly a no.
It's not a no.
More of a no than a yes, but
But boy, it doesn't exactly translate into the headline.
You wouldn't send an all caps headline for that.
No.
Or if you would, it would be Trump is going to do what Trump is going to do. It's just not a very newsworthy
Which
headline.
You could send at any time, at any moment. So it doesn't exactly translate into the headline that Walter Bloomberg sent. I love this only because, Twitter is not real life. But this is a moment where Twitter briefly became real life.
But by the way, as far as I can tell, we're recording this at 2 o'clock on Wednesday. As far as I can tell, the only indication that the tariffs are paused is a Truth Social post.
That's true. That's true. Actually, I saw Lutnick's...
It's not like things get it's not like there's, how a bill becomes a law. It's like there's Truth Social, right?
Yeah.
Which is so weird.
I want to read you something. I thought this was fantastic. So Commerce Secretary Howard Lutnick posted, Scott Bessent and I sat with the president while he wrote one of the most extraordinary truth posts of his presidency. Not sat down with his scroll and his quill and penned out this, poetry like Gettysburg Address. It was a Truth Social post. So, I mean, that is where policy happens on social media now.
We're not going to edit out me just staring blankly.
This is why it needs to be a video podcast. Matt's eyes just sort of went cold and we stared at each other.
I mean, I've written... This is not interesting, but I've written this week about how the Constitution of the United States says that all tariff power is in Congress. And the whole set of rules in the Constitution, in the actual Constitution, about how revenue-raising laws need to be passed, where the House has to initiate them. It's a whole thing. And we have twisted the world where now it's you sit down and you write a consequential Truth Social post, and that's how tax policy gets made. It's pretty weird, man. It's pretty weird.
It is. I don't know.
This is going to be the awkward pauses episode of...
I want to talk about Walter Bloomberg a little bit more.
Yeah.
We know that he's French.
Oh, we do?
I think that one time he posted a screenshot that his browser was in French or something, and that was interesting.
I like that you pay as much attention to Walter Bloomberg as Walter Bloomberg, I'm going to assume, pays attention to Bloomberg.
I mean, I just love anyone who's so committed to the game, and he is so committed to the game of posting screenshots, or rather just posting terminal headlines.
Right. And one thing I was thinking about is what an amazing long game it would be to spend years just posting all cap terminal headlines for people who don't get the terminal and building up a following of people who want to follow Bloomberg terminal headlines in real time for years and years and years of just doing that consistently all the time. And then one day, one fake Bloomberg headline to move the market by $2.5 trillion. What a great trade.
Yeah.
Now, you can't really monetize it because it's you're moving all of the stocks. But I don't know. There's something really beautiful about doing such a enormous stock manipulation is a harsh term, but you manipulated the stocks.
Yeah. I mean, I'm sure you could find some way to monetize it.
Oh, sure. You can just buy some stocks, but it's you can't you don't make $2.5 trillion by moving the market by $2.5 trillion.
Yeah.
Remember when Bitcoin spot ETFs were approved?
Yeah. I'll never forget.
And someone tweeted a fake headline about them being approved.
Yeah, that was nuts.
8 hours before they were approved. And it's everyone knew when the SEC was going to act. And someone tweeted that they got approved a few hours earlier. And there's a little spike in Bitcoin. And it seemed to be some sort of attempt to manipulate the market. But it was so weird. Everyone knew it was going to happen. And it did happen a few hours later. This is not like that. This was, I think, more or less a genuine surprise when Trump really did the thing that he was rumored to do 2 days earlier. But I don't know.
Yeah, that's true. I mean, actually, he did post on Truth Social earlier on Wednesday.
Oh, yes.
Now is a good time to buy.
It's amazing. What an amazing thing to do.
Turns out that was the signal. And I'm so happy that I have this timestamped because I said on TV, this raises the possibility that actually the Trump put does exist. He's clearly watching the stock market and sees it puking right now. And then hours later comes out with this extremely stock market friendly headline.
I know. But isn't it so weird? Because if you listen to the things that the Trump team say, there are things like the tariffs will be good for America in the long term, right?
Yeah.
And then to pause the tariffs, you would think that saying this is the time to buy means because the market is incorrectly reacting to the glorious future ahead of us because of these tariffs. But in fact, it means because I'm walking back the tariffs in a few hours. Or maybe it doesn't mean that. Who knows?
Who knows? He did sign it, DJT or whatever. I can't believe we are actually doing an episode on tariffs.
It is disappointing.
Anyway, so Walter Bloomberg So I think at least the New York Times, but maybe too the Wall Street Journal, DM'd him and he answered and he sort of deconstructed how he got there. He said he saw some other account tweet it.
Yeah,
the market was responding, so then he ran with it. So
this is how everything works, right? Because then news stations were reporting it because they were like, the market is moving. Why is the market moving? Well, is this tweet, so we have to report on the tweet. I don't know. That's a reasonable thought process.
It's a daisy chain.
Yeah.
Yeah, but
it's really it's, right. It's like this little snowball from one person says a thing, and if the market moves on that, then someone else will say it because it's it's often very hard to explain market moves. And so people look for whatever they can. And one crisp tweet explaining the market move is a useful thing. Although here it clearly was the explanation.
Can we have Walter Bloomberg on the show?
I hope so.
I'm going to DM him.
Yeah, let's do it.
I wonder if his DMs are open. I can find out. I can look at my phone right now.
should publish a terminal headline Walter Bloomberg, open your DMs to Katie.
I'm just going to tweet in all caps and put a little asterisk ahead of it so that he'll think it's a Bloomberg headline. So you're saying, it's hard to explain market moves. It's nice to have something crisp to point to. Shall we talk about what's going on in the Treasury market?
I guess.
Yeah. A really satisfying boogeyman is just pointing to the basis trade to explain why bond yields have been blowing out, even though everyone's worried about a recession. And up until an hour ago, stock markets had been pretty much flirting with bear market correction territory. You would expect treasuries to rally and bond yields to fall. That's not what has been happening, Matt.
Yeah. You can tell various fundamental macro stories about how the tariffs would cause treasury yields to rise and stock markets to fall, right? The story that I've been telling is the goal of the tariffs is to have foreigners buy more U.S. goods and fewer U.S. financial assets, which you would think would lead to losses in U.S. financial assets, such as stocks and also bonds. Mm-hmm. But it is also the case that the basis trade exists, and people do like talking about the basis trade. And one reason that people like talking about the basis trades is I've been thinking all week, there's been huge moves in asset prices, driven entirely by economic fundamentals and government policy, right? But huge moves in asset prices. And so every day you wake up and you're well, there's been huge moves in asset prices. What hedge fund is going to blow up, right? Because when there are big fundamental moves, someone blows up, right? And so you think a lot about contagion and deleveraging. And if you think about contagion and deleveraging, and you've been worrying about the basis trade for years, and also know that the basis trade is run at 100-to-1 leverage ratios, then you might think maybe someone is blowing out of a basis trade.
Yeah, it's natural that you would think that. Also, I think it was Torsten Slok over at Apollo who had a note out this week saying that he estimates the basis trade, there's $800 billion in it right now. It makes sense why you would reach for that, given all the things that you just laid out. But I think also that people reach for it because it's hard to prove. We haven't seen any reports of a hedge fund blowing up.
I really scour these reports because I'm very interested in this question. And there's definitely stories people are getting some margin calls, some hedge funds are doing some selling, but no one's this fund liquidated all its positions and shut down, right? There's no real dislocation.
Yeah.
Scott Besson said this morning or said sometime this week, this is a uncomfortable but normal deleveraging.
Yeah.
Which,
you would expect
seems right.
You would expect him to say that.
I know. But it also seems correct so far.
Yeah. Well, there's two trades that we're watching, right? It's the basis trade, but also it's swaps, what's going on with asset swaps. There was a great piece from Edward Bolingbroke, and I kind of lumped these together. But then I was reading a Wall Street Journal article that explained that these are two similar but different trades. That's
asset swaps.
Yeah, swap spreads.
Right. They're related trades because on the one side of either trade, you have owning physical treasury bonds. And on the other hand, you have some sort of interest rate derivative. So with treasury futures, it's the basis trade is you buy a treasury bond and you sell the futures contract that corresponds to that treasury bond. Swap spreads are you sell a interest rate derivative that basically moves with SOFR, but it's it's kind of the same it's an unfunded long-term interest rate contract.
Right.
And there again there's been a trade there where people think like treasuries will do well relative to the derivative for whatever reason. The reason has to be something like people will have better funding to buy treasuries. And so like one of the reasons for the basis trade and the swaps trade is like a belief that Trump would deregulate banks in such a way that banks would be more interested in using their balance sheet to hold actual treasuries. And so therefore demand for physical treasuries would go up relative to like demand for interest rate derivatives, which don't require as much balance sheet. And so banks would buy more treasuries. And so one reason to do like a basis trade of some form is because you think treasuries will go up relative to futures. And so you are betting on someone buying the treasuries from you. And one thing that's happened this week until today is for whatever reason, people are less interested in buying treasuries from you. Some of that is like been baked in for several weeks of like the projections about banks buying a lot of treasuries because of regulation easing up don't seem to be coming true. And then some of it is like whatever fundamental events went on this week where people didn't want to buy treasuries.
Yeah, I mean, the swaps trade, as I understand it, like that peaked in February. So that's been coming off the boil for a while.
Yeah, I think the futures trade has too a little bit, but yeah.
Yeah.
But all those swap spreads collapsed this week.
They cratered. I think that they hit at least a multi-year low, if not a record low.
Yeah.
But yeah, I don't know. I wonder where this goes in this new world order.
I don't know.
I will say that, you know, we were talking about the violent stock reaction to the upside, to the 90-day pause. You saw short end yields in the Treasury market rise pretty sharply. The long end didn't react. Of course, I want to timestamp this. We're talking on Wednesday, mid-afternoon. But I don't know. Like, I hear what you're saying, that a product of these policies would just be people don't want to own U.S. assets in general. But at least Treasuries, the long end of the Treasury curve, had the narrative that, oh, my God, we're worried about the economy. We might as well buy long end Treasuries as a safe haven. But that obviously didn't happen this week.
Yeah, I mean, there's a lot of different markets for it, right? And like to the extent some of the market for long end treasuries is foreign buyers, you could imagine less demand from them.
Yeah, I guess it was expected, though. I mean, I've been tweeting about the Treasury market all week, and I've had a lot of like tinfoil hats about, this is China dumping treasuries. We knew this was going to happen. I guess it was just expected that haven impulse, economic hard times, you buy treasuries, that's your muscle memory, overwhelmed any overseas selling that you would see. Because China and Japan have been selling treasuries for years.
Yeah, I wrote about that today, like Wednesday. Like the muscle memory stuff is like so interesting, right? Like in previous episodes of problems for the credit of the United States, people are like, better buy treasuries, right? And like, it's not obvious that would always last forever.
Yeah.
You might like have some development that made you think, well, if like the demand for U.S. financial assets goes down, then I should sell treasuries rather than buy them.
Yeah.
I don't know.
We'll see. Mortgage rates are still really high, so I'm sad about that. Is there anything else to say about the basis trade at this moment? It seems scary.
Yeah, I mean, like, there's a broader question of like, will anyone blow up in this crazy volatility?
Yeah.
Like, I don't know, like, you know, in general, like the theory is that banks are supposed to make money during periods of crazy volatility. But it's like, that's like in aggregate, and then like one person should blow up, right? Because they just get the crazy volatility wrong, right? Someone was like, oh, the market has so much further to go down, and like they got positioned themselves really short, and then like there was this huge rally on Wednesday afternoon. Yeah, you know, someone's got to blow up. You know?
Come on. I saw some stat that the basis trade is like double the size of what it was in 2020 when it blew up last. And still haven't seen any reports of hedge fund blow-ups. So that'll be fun.
Yeah, that'll be fun. Not an all tariff episode. We do have to talk
about ETFs.
About ETFs.
Can we just say one thing? This was Matt's idea. Matt wanted to talk about leveraged ETFs this episode. I've seen some comments on Spotify. I read all the comments. Someone said that this has turned into a boring ETF podcast. It's not my fault, man. This was Matt's idea, at least for this week.
But this is not a boring ETF. This is
The other ones were, but this one is
some
not.
of them were.
Absolutely.
This is the Defiance MicroStrategy Double Short Hedged ETF. Its trade is it takes your money, it goes short a 2-time levered MicroStrategy ETF, and it also goes short a 2 times levered inverse MicroStrategy ETF. So it is short 2 levered ETFs, 1 long, 1 short. So net, it's short long MicroStrategy and short MicroStrategy, each one doubled. So it's nothing, right?
Yeah.
It is neither long nor short MicroStrategy. All it is it is short the weird structural feature, which we've discussed more than once on this podcast, the weird structural feature of levered ETFs, which is that they track 2 times the move in MicroStrategy each day. But if you hold them for more than 1 day, they fail to track 2 times the move in MicroStrategy and they get weird. And like much of the time, the way they get weird is they have some like slippage where they get less than the expected return.
Yeah.
And so if you're on the other side of that, you're getting more than the expected return basically. And so like this thing has like a back test that makes like 13% or something with no market risk, no correlation to anything else, just like a weird anomaly in the ETF market.
Yeah, this is a real Frankenstein.
Oh, yeah.
I mean, as you laid out, leverage ETFs, both long and short, they are 1-day only funds, especially, for some of the crazier ones. That's really the only realistic holding period. I am a little bit salty because I wrote about a similar trade in my newsletter. It's called ETF IQ, about Rob Arnott of Research Affiliates.
You did.
He does this trade
in his PA
on the side. He told me that he likes to short both leverage long and inverse ETFs, and he described it as a slow, boring money machine, which I find really charming because, I mean, you would think that you would have to have a strong stomach to do this, to be shorting leveraged ETFs, but I mean, as you just
Not
laid
if you
out,
short both sides.
Exactly.
I mean, you probably should have a strong stomach because like it's a boring money-making trade for a reason, which is that it has some probability of blowing up in your face, right?
Yeah.
And the way it blows up in your face is like, basically the way these ETFs work is like they rebalance each day. And so the long one, like every time the stock goes up, it has to buy more stock. Every time the stock goes down, it has to sell more stock. And so it is like volatility amplifying.
Yeah.
And if the stock bounces around a lot, then it's constantly buying high and selling low and like bleeding. It's like people call it like volatility decay. Like they're bleeding like value each time they buy high and sell low. But if the stock keeps going up, you're just compounding that. And so in fact, if the stock like goes up every day, you get more than 2 times the return on MicroStrategy because you're like, you keep buying into it. And so similarly, if you do this trade and the stock moves in one direction for a long time, like you're no longer fully hedged, right? Like one of your legs does much better than the other leg. So, it's a risky trade.
Yeah.
It's, it's effectively a market making trade, right? Like these ETFs are like creating volatility. They're trading with someone on the other side who is like kind of a market maker and like selling them the volatility that they're giving people. We talk about them so much. Like they're so
on this podcast.
But people talk about like in general, they're sort of like a known thing that people kind of make fun of.
Yeah.
And so if you're like a second level sophisticated retail investor, it's like, I know that people make fun of these like double levered ETFs. How do I get on the other side of that? And it's like, well, there's an ETF for that too.
Yeah,
right?
yeah.
Like people like Rob Arnott are like, oh, how do I get on the other side of that? And you like do the trade. But then like someone's like, how do I package being on the other side of that and sell it to more retail investors? It's a great trade.
Well, something that Rob and I talked about is that, yes, it's a great trade, but the borrowing costs can be pretty punishing.
Yeah.
He gave me some details on his returns from doing this. And, I wrote this at the end of March, so things have changed. But he said that 2024's gain for shorting, again, both long and inverse triple leveraged ETFs, was around 13%. Half of that went to borrowing costs for the short positions. You add in about 5% for collateral, and the return was about 12%, but that's with zero beta, zero correlation to just about anything.
That's a great trade.
Not a brilliant strategy, net of costs, but fun and low risk. Yeah. So it's fun.
It's fun.
Yeah.
It's one thing for Robert not to do it. I like the idea of like, you look at the landscape of ETFs and you're like, what ETFs should people get mad about? I'm going to do the opposite of them.
Yeah.
It's like, this is like the very like arcane version of that. But there were like, anti-Cathie Wood ETFs where it was like, what are people negative about? I'm going to sell an ETF that packages that negativity. This is like, people are negative about double levered ETFs. I'm going to find a way to make money on that.
Here's the other side. Yeah. I'm interested to see these launch. It's just a filing so far.
Sure.
Rob did also say to me that anyone who buys a triple leverage ETF is crazy if they don't lend it out, because he did mention that there's a relatively short supply of these leveraged ETFs that are available for lending, which is interesting.
Yeah, but like everybody who buys a triple levered ETF is doing it in some sort of retail account, and some of them may not be aware that they can lend it out, or their broker is lending it out for them.
Probably.
So as I mentioned, next week I'm on vacation. And so I will not be recording a Money Stuff podcast, but fear not.
Fear not.
In approximately 15 seconds, we'll be recording a mailbag episode, which will air next week.
Mailbag.
And that was the Money Stuff podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on open interest between 9 to 11 a.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net. Ask us a question and we might answer it on air.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff podcast is produced by Anna Mazarakis and Moses Andam.
Our theme music was composed by Blake Maples.
Brendan Francis Noonan is our executive producer.
And Sage Bauman is Bloomberg's head of podcasts.
Thanks for listening to the Money Stuff podcast. We'll be back next week with more stuff.